December 23rd, 1913, the Oval Office in Washington, D.C. Woodrow Wilson is 57 years old, standing at a moment he has deliberately delayed until just 3 days before Christmas before putting his signature on what would become one of the most significant financial laws in American history. 3 separate pens are used during the signing. Each pen is later handed to different political allies who helped move the legislation through Congress. The Federal Reserve Act establishes 12 regional Federal Reserve banks. Hidden within its technical structure is a key requirement that very few outside the banking committees fully grasped at the time. Every Federal Reserve note issued into circulation must be supported by gold reserves equal to at least 40% of its value. Not as guidance, but as binding law. This rule functioned as a strict constraint. Any expansion of currency required a corresponding increase in gold held in reserve. The design was meant to prevent uncontrolled issuance of money and to enforce a mathematical discipline on monetary expansion. Supporters of the system believed they had created a permanent barrier against excessive currency creation, the kind of behavior where central banks expand money supply to address problems that cannot truly be solved through printing currency. Wilson held the view that the institution he helped establish would avoid the excesses seen in some European central banks, which had at times moved too far from tangible backing. That belief holds for only about 20 years. Understanding what changed requires looking at how the original 1913 structure was gradually dismantled, not through a single decisive reversal, but through a series of separate steps, each smaller and less visible than the last, and each designed in a way that reduced public resistance. The first major shift arrives in 1933 and 1934. Executive Order 6, 102 requires American citizens to turn in gold coins, bullion, and certificates to the Federal Reserve in exchange for paper currency, under penalties that include fines and imprisonment. Soon after, the Gold Reserve Act transfers gold held by Federal Reserve banks directly to the Treasury. At the same time, the official valuation of gold is changed from $20.67 per ounce to $35 per ounce. That adjustment represents a dollar devaluation against gold of roughly 41% in a single legislative move. This stage is highly visible. It triggers public awareness and political conflict across the country. The second adjustment happens in 1945. Congress lowers the required gold backing for Federal Reserve notes from 40% down to 25%. The explanation given centers on post-war economic growth and the need for a larger money supply than the old ratio could comfortably support. The change attracts limited public attention. Most coverage treats it as a technical revision rather than a structural shift in how money is anchored. The final and most decisive stage arrives on March 18, 1968. President Lyndon Johnson signs Public Law 92-269, removing the gold reserve requirement for Federal Reserve notes entirely. The requirement does not get reduced further. It is eliminated completely. 0% remains. This is why 1968 is often viewed as the decisive turning point where the Federal Reserve System effectively altered its operating rules, and why this date carries greater weight than the more widely recognized milestone. By the middle of the 1960s, the United States was experiencing a steady outflow of gold. Spending linked to the Vietnam War, combined with Lyndon Johnson's Great Society initiatives, was driving persistent deficit expansion, the exact condition that a gold-based monetary framework is designed to limit. At the same time, foreign governments grew increasingly doubtful that American gold reserves were sufficient to cover all dollars circulating abroad. As confidence weakened, they began converting their dollar holdings into physical gold at a faster pace under the Bretton Woods system. American gold reserves, which stood at roughly 20,000 metric tons following World War II, had declined to near 10,000 tons by 1968. Half of the total had disappeared within 2 decades. By that point, the existing 25% reserve requirement had become a real operational limit on the Treasury's ability to manage ongoing gold outflows. Every ounce of gold locked in domestic backing requirements was an ounce that could not be allocated to satisfy international redemption demands from foreign central banks under the Bretton Woods arrangement. Congress responded with a simple but consequential adjustment, one that was presented in a low-profile manner. The domestic requirement that tied gold reserves to currency backing was removed, freeing that gold from its previous legal constraint on domestic money. The legislation passed. The measure became law. Media coverage treated it as a technical revision, overshadowed by major news related to the war and civil rights developments. There was no national address, no formal televised announcement, no public emphasis. Only a presidential signature, a brief press statement that drew little attention, and the quiet ending of the final legal link between dollars in everyday circulation within the United States and any physical gold reserve stored in vaults. 3 years later, in August 1971, President Richard Nixon shut down the international gold window as well. But by that point, the domestic discipline framework originally established in 1913 had already ceased to exist for 3 years. Most accounts focus on 1971. Far fewer recognize 1968, even though it removed the constraint first. The more visible break receives the attention, while the quieter, structural change passed with minimal notice. At the same time, the gold requirement was only one part of the original discipline system created under Woodrow Wilson's Congress. The other component involved reserve requirements placed on banks themselves, and that structure also underwent a complete transformation over time. Separate from gold backing rules for Federal Reserve notes, the original Federal Reserve Act required member banks to maintain a portion of their deposits as reserves, either in cash or held at regional Federal Reserve banks, preventing them from lending out every dollar they received. This requirement remained in place, in adjusted form, through the changes of 1933, 1945, and 1968, lasting for more than a century. It functioned as the final structural limit on how much lending capacity could be created from bank deposits at any given moment. On March 26, 2020, the Federal Reserve set reserve requirement ratios for all depository institutions to 0%. The change occurred during the early weeks of the COVID-19 pandemic, communicated through a press release that was largely eclipsed by lockdown announcements, market circuit breakers, and a historic rapid decline into bear market conditions. The official explanation described it as an emergency measure intended to support lending during an abrupt economic shutdown, removing constraints so banks could extend credit more freely. Although the emergency conditions passed, the 0% reserve requirement remained in place. It continues at 0% today. This completes the full structure as it was originally designed. The gold backing rule tied to 1913 was removed in 1968. The reserve requirement on deposits, also rooted in 1913, was eliminated in 2020. Both elements of Woodrow Wilson's discipline framework were dismantled, not in a single turning point that could easily be contested, but through two separate episodes, decades apart, each introduced during periods when public focus was directed elsewhere by more immediate events. When people say the banking system has already moved beyond those original constraints, it is not a figure of speech. It refers to a structural shift. Under a functioning reserve requirement, a bank is forced to keep a portion of deposits idle. That idle portion acts as a buffer against sudden withdrawals and limits how aggressively funds can be deployed. Once that requirement is removed, the constraint no longer exists in law. What remains is internal judgment. Risk limits become voluntary, shaped by each institution's own policies rather than a mandatory floor imposed from outside. The March 2020 period made this clear. Silicon Valley Bank did not collapse because it broke any reserve rule. No such binding requirement existed anymore. Instead, it concentrated a large share of its holdings in long-duration government bonds. When interest rates rose, those assets lost value. Without a regulatory structure forcing a more liquid balance, the risk exposure had been allowed to build internally. Signature Bank and First Republic followed similar patterns of vulnerability. Data from the FDIC showed unrealized losses across the banking system reaching approximately $515 billion at the peak of the 2023 stress period. Those losses accumulated within a system where the earlier discipline constraint that might have limited such concentration risk had already been removed 3 years earlier. The original 1913 framework was built around two mechanical limits. One was tied to gold, the other was tied to deposit reserves. The intent was to reduce reliance on voluntary restraint, under the assumption that internal discipline alone would eventually fail under pressure. Both limits are now gone. The institutions operating today function within a structure that differs fundamentally from the one that framework originally attempted to establish. The banking instability seen in 2023 became the first major visible test of that environment without those constraints. The sequence of removals occurred in two distinct stages, separated by exactly 52 years. Each change happened in isolation, and each was justified within its own context at the time it was enacted. If there is a remaining layer of discipline in the modern system, it now rests in areas such as capital requirements, stress testing frameworks, or deposit insurance structures. The question that follows is which of these remaining mechanisms, if any, could face gradual reduction next, and what external event might dominate attention at the time such a change occurs. The discussion is open. Add your perspective below.